The last time, two times, well, the only two times silver went to around $50. Back in the late 70s, early 80s, we saw almost a breakdown of the dollar system, having been the money of the masses for thousands of years, reflected that. And the same thing, I guess, in 2011, we saw the European sovereign debt crisis, and silver that year, when that crisis started, 2011, went to 50. So that's why I mentioned silver. The JGB market, that's the Japanese government bond. I've been covering it for years on my channel, that eventually all the debt and liquidity created by the Bank of Japan, and all the debt that's been taken by the government there, is going to come home to roost. We've been told by the Keynesians and mainstream economists that Japan has always been in a danger of deflation. But in the last 12 months, I think rice prices went up 100%. So the public, they're starting to feel the pinch.
Silver has historically acted as a reliable barometer for monetary distress, and that pattern may now be repeating. According to market analyst Mario Innecco, both previous spikes in silver to the $50 level, the first during the late 1970s and early 1980s, and the second during the European sovereign debt crisis in 2011, coincided with critical breakdowns in sovereign debt confidence and systemic fiat credibility. In both cases, silver surged not simply due to speculative mania, but as a direct reflection of growing mistrust in government bonds and official currencies. Now, Innecco draws attention to Japan, long perceived as an exemplar of debt deflation resilience. But the illusion is fracturing. Rice prices, a key staple in Japan, have doubled over the past year, challenging the decades-old narrative of entrenched deflation. The Bank of Japan's monetary experiment, defined by aggressive debt monetization and yield curve control, appears to be unraveling. Yields on Japanese government bonds, JGBs, have started to spike, and a recent political upset has introduced a layer of fiscal uncertainty that the Ministry of Finance is ill-prepared to contain. Innecco sees these symptoms not as isolated economic developments, but as precursors to a potential systemic shift. If history is any guide, this shift could manifest again through the silver market. The last two silver spikes corresponded to moments when public trust in fiat debt instruments sharply eroded. Japan's current trajectory, rapid inflation in consumer essentials, rising bond yields, and political instability, presents an eerie parallel. If global bond markets lose confidence in the Japanese fiscal position, the contagion could extend to U.S. Treasuries and European government bonds, replicating conditions not unlike those of the 2011 euro crisis or the 1979 and 1980 U.S. dollar panic. Innecco's thesis is grounded in observable macro signals: commodity inflation amid persistent monetary expansion, spiking bond yields in a structurally indebted economy, and the retreat of mainstream investors from government debt. This environment creates the conditions for silver to again emerge as a flight-to-safety asset, particularly for contrarian investors looking to hedge systemic risk outside of the dollar and euro frameworks. Given that silver remains significantly underpriced relative to historical inflation-adjusted highs and gold's current levels, as we enter an era of escalating global bond stress and geopolitical reconfiguration, the Japanese bond market may be the first domino to fall, and silver, as it has twice before, may be preparing to react in kind. Stick with us as we unpack Mario Innecco's broader analysis on supply stress in the silver market, the collapsing credibility of paper-based ETFs, and the rising likelihood of a physical squeeze that could upend Western pricing mechanisms. If you're an investor searching for clarity amid the noise, you won't want to miss what's coming next. Be sure to like this video, subscribe to the channel, and stay until the end. Thanks, and enjoy the video.
I worked in the futures market for 20 years, mostly trading government bond futures and interest rates. And I did follow gold futures and silver futures quite closely once I started buying gold in '02. But I don't follow the data very closely. A lot of people do, and sometimes I look at what people say. But one thing that seems to be happening that I think is quite important is that the supply the of physical silver in the COMEX warehouses is dwindling, and it's at record lows. I think 155 million ounces. And what you need to understand is that the COMEX itself doesn't have like a warehouse. They just have they just say, oh, this warehouse owned by JP Morgan or whoever, that is qualifies as a COMEX warehouse. So I think that's an important aspect of things. And I've noticed as well, I don't know how it's developing right now, but that open interest in gold futures is dropping a lot. Open interest means that the higher the open interest, the more the public is involved in the market. So it looks like people are not getting as involved. So yeah, and I've seen recently as well that the SLV, which is the ETFs for silver, uh, I think it was last week and today as well, you can't borrow shares from the SLV. And why would you want to do that? Well, I think the bullion banks, they did that with PSLV a few months ago, if you remember. If you remember it, they were borrowing the shares to sell the SLV to keep the net holdings of SLV like neutral, because there are a lot of people buying PSLV, excuse me, and the trust had to buy physical. So if the swap dealers or bullion banks were able to borrow PSLV and sell it, it neutralized that increase, so they didn't have to buy physical. So they're trying now, I think, with the SLV, but the problem is uh, they can't borrow. The lease rates for SLV shares has gone through the roof, and I think that squeeze in silver is going to continue. And today, as we speak, gold is tested 3,400 again in the spot, and we're close to 39 again as well in spot silver. Yeah, I mean, I follow that guy on X. I've communicated with him, and yes, I'm sure others will follow. I think he was the founder of a tech company and did really well, and he sold his shares or the company. So yeah, I think that would be yeah, that will happen, I think. And back in the 70s and 80s, the Hunt brothers were the main like guys who went into physical silver. They started actually buying futures in the early 70s and taking delivery in the early 70s. And I suspect it's because when Nixon closed the gold window in 71, they knew what was coming in terms of inflation, but they couldn't buy gold, so they started with silver. But then they got over their heads a little bit, and the regulators and the Fed came after them. But when you have dozens of small, not small, of course, they're billionaires, but dozens of people with a lot of wealth, and maybe half of them start buying silver like that, it could make a huge difference. And I agree with Andy Schechtman. I've been telling people ever since I started following gold when I bought my first Krugerrands in '02. I noticed that the markets behaved in a funny fashion, like they did the same thing at, at a certain time every day, which is unusual for markets. And then I discovered GATA, Gold Antitrust Action Committee, and Bill Murphy. And that's one of the things he said. Physical, you need physical, you need to take delivery. But on these exchanges like COMEX, uh, yeah, unless you're a big fish, they're not going to like make it easy for you to take delivery. I think 2 or 3 years ago, Rafi Faber with a few other guys tried to take a delivery of one contract of silver, which is 5,000 ounce bar, and they made it so hard they had to give up in the end. So yeah, it's definitely the kryptonite, taking delivery, and I think it was one of the reasons why they created because the bankers are behind these ETFs. They created the gold ETF. I think it was '04, if I'm not mistaken, and they created SLV as well because that, that basically makes people not go for physical because people want convenience and they don't want the hassle of buying. For some reason, people are think it's a hassle to buy physical gold and silver. On X, someone came out that a company in Japan called Tanaka Precious Metals. They had a program where you could buy physical silver, I think, and keep it in their vaults. And now they're saying that as of December or like when the program ends, you're going to get your cash settlement, not physical. So it's really difficult to trust all these ETFs and things like that. But in terms of manipulation, you're saying about the manipulation of gold and silver, some people might say, well, if they've been manipulating it, how come the price is going so much higher? And my retort or my answer to that is that they try to keep the public scared of going into gold and silver because sometimes they come in and they smash the price and they create a lot of volatility. And I don't know if you've seen this, Jesse. Back in the 70s, there was communication between the London bullion dealers and the US Treasury and also the State Department about the coming legalization of gold on January 1st, 1975. And one of the dealers in London said, yes, the creation of a futures market should help keep Americans away from hoarding physical gold because it's going to create a lot of volatility and the futures market is going to dwarf the physical market. So that's how they do it. But yeah, I think people are waking up to the fact that the only real way to own gold and silver is to buy the real thing. And I think the billionaire there, Mr. Bateman, is an example of that.
Innecco's long-term view on the silver market is shaped by more than historical parallels. It's also grounded in structural stress within the physical bullion system. COMEX registered silver inventories have dropped to record lows, reportedly near 155 million ounces, a level not seen in over a decade. While COMEX technically doesn't hold these metals directly, relying instead on affiliated third-party storage such as JP Morgan's vaults, the fact remains that the deliverable supply is shrinking rapidly. This drop in registered silver occurs in parallel with weakening open interest in futures contracts, suggesting waning participation from retail and institutional speculators. It also raises critical concerns about deliverability in times of market stress. Innecco also underscores a key behavioral shift. High net worth individuals and institutional investors are increasingly bypassing the futures market and ETFs altogether in favor of direct physical acquisition. From Japanese firms like Tanaka Precious Metals halting physical redemption programs to growing skepticism about custodial integrity in the West, Innecco argues that the window for large-scale physical conversion is rapidly closing. The disconnect between the paper and physical markets is further magnified by geopolitical realignment. As Western exchanges like COMEX and the LBMA continue to rely on synthetic contracts to suppress volatility, nations like Russia and China are actively developing alternative gold and silver exchanges anchored in physical delivery. Let's now examine how this transformation is accelerating and what it could mean for the future of price discovery.
You pointed out on your channel recently that Japanese government bonds and silver are pointing to a major financial upheaval. Break down what you're seeing there for us.
Yeah, silver, I guess the reason why I said that is because the last time, two times, well, the only two times silver went to around $50, back in the late 70s, early 80s, we saw almost a breakdown of the dollar system. We saw the US Treasury issuing bonds in Deutschmark and Swiss francs. They were called the Carter bonds. So that was like I think, a a signal that things weren't well, and silver, having been the money of the masses for thousands of years, reflected that. And the same thing, I guess, in 2011, we saw the European sovereign debt crisis in the countries of the south of the EU, like Portugal, Italy, Ireland, Greece, and Spain. I know Ireland is not in the south, but it was kind of in the same fiscal situation. And silver that year, when that crisis started, 2011, went to 50. So that's why I mentioned silver. The JGB market, that's the Japanese government bond, I've been covering it for years on my channel. That eventually all the debt and liquidity created by the Bank of Japan, and all the debt that's been taken by the government there, is going to come home to roost. Uh, we've been told by the Keynesians and mainstream economists that Japan has always been in a danger of deflation. But in the last 12 months, I think rice prices went up 100%. So the public, they're starting to feel the pinch. They know that deflation is really not there. And by deflation, I mean falling prices. I know that deflation is the collapse of the money supply, but things get confused a little bit. But now, in Japan, the long-term yields for JGBs are spiking massively, and they could spike even more starting this week, because we had an election this past weekend in Japan, and the government lost its majority in the upper house, and that's quite serious, because the opposition, they want more fiscal stimulus, they want more tax cuts, and the Ministry of Finance and the Bank of Japan, they're trying to rein in all the this money printing and liquidity. So this is throwing a spanner in the works. It could spook investors, and JGB yields could rise even further, and that weakness and drop in JGB prices could spread to treasuries and other government bonds, like the gilts and the European government bonds. So that's why I think it's very important to keep an eye on silver and Japan.
So this has caused obviously a lot of speculation online that St. Petersburg Exchange will become a competitor to Western exchanges like the LBMA, and could lead to a major move in the gold price. What are your thoughts on this development?
Yeah, and Moscow also has an international gold exchange. So this is just an additional exchange in Russia. And I read something about this new exchange in St. Petersburg, and the Russians, they know what's going on because they say London controls the market now, even though the UK doesn't produce any gold. And the reason they can control it is because sovereign countries are daft, or I don't want to say, or stupid enough to leave all their gold with the Bank of England. That's how they do it. And basically, the Russians are saying, we're not going to leave our gold with the UK, and we produce the most gold. We're going to have our own market. And I think that's going to chip away even more at the paper games on LBMA and COMEX, because COMEX and LBMA are kind of linked. They're attached at the hip, I would say, and their objectives is not really to have a physical market that functions for physical delivery. Yes, sometimes big actors take delivery in London, but for us, the public is just supposed to be something, to speculate on. But I think the Russians, they're more serious about having a real physical market. And yes, this is just going to continue to chip away at the West's, and especially London's, control of the price finding mechanism. And Shanghai, they're doing the same thing. Shanghai Gold Exchange, they're opening also depositories elsewhere. So yeah, I think the trend is for more and more real physical gold and silver trading. And I think the Russians are very much aware of and they had like a economic advisor to President Putin who went there, and he found out about all the bullion bank paper game in gold and silver, especially as it pertains to JP Morgan and the bullion banks. So I think the Russians are aware of this, and so are the Chinese, and they know that the Achilles heel of the Anglo-American empire is the fact that they've kept their currencies inflated, and like they've kept the perception that they have value by suppressing gold and silver. So yeah, it's interesting times, and I think they might even open other exchanges. Who knows?
Innecco's warnings about Japan and silver dovetail with a larger geopolitical trend: the systemic shift away from Western paper markets toward decentralized, physically settled exchanges. He highlights the emergence of Russia's St. Petersburg exchange, which will begin trading gold physically stored at the state mint, Gokran. This effort is not merely symbolic, it is a direct challenge to the dominance of the LBMA and COMEX. Russia, the world's largest gold producer, is effectively opting out of the Western gold game, asserting monetary sovereignty and shaking the foundations of the Anglo-American financial architecture. What makes this development more profound is the precedent already set by the Shanghai Gold Exchange, which has been slowly eroding LBMA's monopoly by facilitating physical gold delivery in yuan. Both Russia and China understand that the suppression of precious metals, especially silver, is a key pillar in preserving the illusion of fiat stability. By undermining the paper mechanisms that underpin Western dominance, they are accelerating the shift toward a more transparent and physically anchored metals market. This could lead to a bifurcated pricing regime, one for synthetic, cash-settled futures in the West, and another based on physical supply and demand in the East. Innecco reinforces that physical possession is not just a defensive investment strategy. The bullion banks, by flooding the market with unbacked futures contracts and using ETFs to siphon retail demand, have suppressed prices for decades. But this suppression is cracking. Delivery requests are increasingly being denied or settled in cash. Lease rates are spiking, and trust in custodial integrity is collapsing. As institutional players start demanding the real metal, and as sovereigns build their own pricing infrastructure, the Western suppression model becomes increasingly unsustainable. The implications for investors are enormous. Should this East-West divergence continue, the silver market may experience a repricing shock, realigning to reflect actual physical scarcity. Innecco's view is that this isn't a distant possibility. It's already in motion. The collapse of trust in sovereign debt, the rise of inflation in previously deflationary economies like Japan, and the fracturing of global exchange systems all point in one direction. Silver is not just a commodity, it is money, and it's about to reassert that role on a global scale. The playbook is changing. As institutional confidence in synthetic instruments erodes and physical demand rises, the smart money is positioning for a paradigm shift. If you believe in sound money and want to stay ahead of the curve, subscribe to the channel, hit the notification bell, and share this video with like-minded investors. The era of paper silver is ending, and you don't want to be on the wrong side of history. Thanks for watching.